Investing can seem intimidating, especially for beginners who may feel they lack the necessary funds. This video will explore how much money you need to start investing, the various investment options available, and provide practical tips for beginners. Before we move forward, please take a second to like and subscribe to our channel. How much money do you need to start investing? The myth of needing a lot of money. One of the most persistent myths about investing is that you need a large sum of money to get started. While it is true that some investment opportunities require substantial capital, many do not. The reality is that you can start investing with a modest amount of money, sometimes as little as $5. Micro-investing platforms. Micro-investing platforms, such as Acorns, Stash, and Robinhood, allow individuals to start investing with very small amounts. These platforms often round up your purchases to the nearest dollar and invest the spare change. For example, if you buy a coffee for $2.75, the platform will round it up to $3 and invest the 25 cents. Over time, these small investments can grow significantly. Employer-sponsored retirement accounts. If you have access to a 401k or another employer-sponsored retirement plan, you can start investing with minimal contributions, often as low as 1% or 2% of your salary. Many employers offer matching contributions up to a certain percentage, effectively doubling your investment. This means that if you contribute 3% of your salary to your 401k and your employer matches that contribution, you are actually investing 6% of your salary. This employer match is essentially free money and can significantly boost your retirement savings over time, making it one of the most beneficial ways to start investing with limited funds. Online brokerages. Online brokerages, such as Fidelity, Charles Schwab, and E-Trade, have significantly reduced the barriers to entry for new investors. Many now offer commission-free trades and have no minimum account balance requirements, making it easier than ever to begin investing. This means you can start investing with whatever amount you feel comfortable with, whether it's $50, $500, or any other amount that suits your budget. These platforms provide access to a wide range of investment options, including stocks, bonds, mutual funds, and ETFs, enabling you to build a diversified portfolio without needing a large initial investment. Types of investments for beginners. Stocks. Stocks represent ownership in a company and offer the potential for high returns. As a beginner, investing in individual stocks can be risky, but it can also be rewarding. It's important to do thorough research and consider diversifying your investments to mitigate risk. Bonds. Bonds are essentially loans you give to a government or corporation, which they pay back with interest over time. They are generally considered lower risk than stocks and provide a steady stream of income, making them suitable for beginners looking for stability. Mutual funds and ETFs. Mutual funds and exchange-traded funds, ETFs, pool money from many investors to buy a diversified portfolio of stocks, bonds, or other securities. They offer instant diversification and are managed by professionals, making them an excellent choice for beginners. Real estate. Real estate can be a more complex investment, but platforms like Fundrise and Realty Mogul allow beginners to invest in real estate with relatively small amounts of money. These platforms pool funds from many investors to purchase properties, providing exposure to real estate without the need to buy a property outright. The robo-advisors. Robo-advisors, such as Betterment and Wealthfront, use algorithms to create and manage a diversified portfolio based on your risk tolerance and investment goals. They require minimal effort on your part and often have low fees, making them an attractive option for beginners. Steps to start investing. 1. Set clear financial goals. Before you start investing, it's crucial to establish clear financial goals. Are you investing for retirement, a down payment on a house, your child's education, or another significant expense? Your specific goals will significantly influence your investment strategy and risk tolerance. For instance, if you are investing for retirement and have several decades until you retire, you might be more inclined to take on higher-risk investments with the potential for greater returns. Conversely, if you are saving for a down payment on a house you plan to purchase in the next few years, you may prefer more conservative investments to protect your principal. Clear goals provide direction and help you determine the appropriate timeline and risk level for your investments. 2. Build an emergency fund. Before allocating money to investments, it's essential to establish an emergency fund. This fund should cover 3 to 6 months' worth of living expenses and act as a financial safety net in case of unexpected expenses or financial setbacks, such as medical emergencies, job loss, or urgent home repairs. Having an emergency fund ensures that you won't need to liquidate your investments prematurely, which could result in losses if the market is down. It provides peace of mind and financial stability, allowing you to invest with confidence and a longer-term perspective. 3. Pay off high-interest debt. If you have high-interest debt, such as credit card debt, it is generally advisable to pay it off before you start investing. The rationale is simple. The interest rates on such debts are often significantly higher than the returns you would typically earn from investments. For example, if your credit card charges 18% interest annually and your investments are expected to return 8%, paying off the debt provides a guaranteed return equal to the interest rate of the debt, which in this case is much higher than the potential investment returns. Eliminating high-interest debt improves your financial health and increases the amount of money available for investing in the future. 4. Educate yourself. Take the time to educate yourself about investing. Read books, take online courses, and follow financial news. Understanding the basics of investing will help you make informed decisions and avoid common pitfalls. Common mistakes to avoid. 1. Trying to time the market. Timing the market, or attempting to buy low and sell high, is extremely difficult and often leads to poor investment decisions. Instead, focus on long-term investing and maintain a disciplined approach. 2. Overreacting to market volatility. The stock market can be volatile, and prices can fluctuate significantly in the short term. Avoid making impulsive decisions based on short-term market movements. Stay focused on your long-term goals. 3. Lack of diversification. Putting all your money into a single investment can be risky. Diversifying your investments helps spread risk and can lead to more stable returns over time. 4. Neglecting to rebalance. Failing to regularly rebalance your portfolio can lead to an asset allocation that no longer aligns with your goals and risk tolerance. Make it a habit to review and adjust your portfolio periodically. Starting to invest can be a daunting prospect, but it doesn't have to be. With the advent of micro-investing platforms, online brokerages, and robo-advisors, it's possible to begin investing with very little money. The key is to start small, educate yourself, and remain disciplined. Set clear financial goals, build an emergency fund, and pay off high-interest debt before you begin. Diversify your investments and regularly review your portfolio to ensure it aligns with your goals and risk tolerance. Avoid common mistakes, such as trying to time the market or neglecting to rebalance your portfolio. Remember, investing is a long-term journey, not a get-rich-quick scheme. With patience and persistence, even small investments can grow significantly over time. Whether you're saving for retirement, a home, or another financial goal, starting to invest is a crucial step towards securing your financial future. Thanks for watching, and don't forget to like and subscribe.